Good afternoon. Hello, everyone. Thank you very much for joining me for this presentation. You should be able to see my screen. If you can't, please, in the question pane, just type in if you can't see the slides. And okay, so my name is Brad Renard. I'm the Chief Investment Officer for QTR Capital Management, and that's a sister company to Upside Options. So I think this slide set is actually labeled as QTR Capital, but they're both related companies. So the objective of this presentation is overview of stock and ETF methodologies that can navigate and protect investment gains and capital in an expensive market. So that's what we're going to primarily talk about. This market is pretty expensive. Actually, today was the first down day that I've seen in a long time. This market just wants to keep on going higher, but we'll talk about it. Okay. So these are the questions that I will address in this presentation. How do the major indexes and charts look and sector ETFs? What do they look like and what are they telling us? What are the breadth indicators telling us? How do corporate earnings look and what are the analysts projecting for corporate earnings? What's the price action of Apple, Microsoft, Google, the big mega caps, plus the high flyers like Tesla, Shopify, DocuSign, Teladoc, things like, companies like that. What's that telling us about sentiment? How expensive is this market? Could it go higher or will it correct? By the way, it's currently trading at 23 times forward earnings, so it's pretty expensive. So it's the highest level that I've seen in 30 years. Is it sustainable? What are the why are actively managed strategies and well-defined entry and exit rules required in this type of market, especially when the market is expensive? So that's what we're going to primarily talk about in this presentation. Should I add short exposure hedges to my portfolio? Should I buy bond funds? Is the risk-reward trade-off of holding the major indices or lightly managed funds or passive funds, that have hundreds of holdings, is it optimum right now or not? What's better right now? Value, growth, small caps, mid caps, large caps, emerging markets, European, Asia, thematic. So we'll talk about that. Which sector ETFs and stocks are best to rotate into now? All right, let me just check to see if there are any questions. Okay, so I'm assuming that everyone can hear me and everyone can see the slides. Okay. All right, so I'm the Chief Investment Officer of QTR Capital. That is a registered investment firm. I'm Chief Publisher of Upside Options, and I've been publishing newsletters since 2004. So QTR Capital is a registered firm, and then usually investment publications, newsletters, those are not registered. I'm an adjunct professor. I teach at Chapman University and a couple other universities when they need me. My focus is on management science, statistics, econometrics, and analytics. I was in high tech for 20 plus years in Silicon Valley. I started off as an electrical engineer at GE Aerospace Division. That was in New Jersey. Then I moved after business school. I moved into marketing, sales. I held roles like a VP of sales, marketing, sales rep, director of sales, marketing manager. I co-founded an internet infrastructure company. That was one company I did co-found, and that's and then one larger company I worked with and I worked at, and it was the industry I was primarily in was Cadence Design Systems, and that is chip design software. It's all the software that electrical engineers use to design microprocessors, memories, video chips, things like that. I also worked at myriad smaller companies, mostly in the chip design space. And then when I co-founded this company, this was an internet company here. I was in Japan for a couple of years running one of the branch offices, and my education is in physics, electrical engineering from Columbia, and a MBA from University of Chicago Booth School of Business. Okay, just an overview of what we offer, and this is what I'm going to talk about. I'm going to kind of talk about the guts of what's behind these strategies, and then this will be helpful. So if you want to do it yourself, you can follow these strategies similar to what I'm talking about, or if you want us to do it for you, we're available. So we have large cap, we have a small and a mid cap, we have a sector rotation, we have an opportunity one fund. This one's kind of interesting. This one is going to run just for another 6 to 9, maybe 12 months. And then I'm going to shut it down. So the objective is to hit 50+% gain on it. And it's basically picking up all of the depressed restaurant, retail, department stores, clothing manufacturers, hotels, casinos, anything that was hit by COVID. So this strategy is already up a lot. It's already up 42%. My guess is it'll probably be up plus 80% when I close it down. I would just run it for a year. And I started in October. I started seeing breakouts in October for all of these reopening trades, the restaurants, for example, and the malls and stores that are in the malls. And so I actually, it was probably July, August, like August, September, I started building it and pulled it all together. And then I launched it in October. And again, it's just going to run for 1 year. It might even end up with 100% gain. We'll see. Global Sector Rotation ETF, this is kind of an interesting one. This one can actually replace a lot of your broad indices. If you're just holding the indexes, I'm going to talk about why that's usually not a great idea right now, especially in an expensive market. And these are all actively managed. And I'm going to talk about active management, what you have to do if you want to do it yourself, the time you have to put into it and the expertise you need to gain. Iron Condor Pinnacle, that's a long running strategy. That one's been running for about 19 years. And that's a non-directional options trading strategy, generates usually 3 to 5% monthly. And then this one, Dividend Income Plus, this is a newer strategy, comes in from my partner he's been running this one on several million for the last 4 years. And it takes advantage of dividends. And it's unique. Everything we do is pretty unique. So that we buy a concentrated basket of blue chip dividend paying stocks, about 7 stocks, usually 5% dividend payers. We then lever it up by 4 times. And then we open up a 2 threshold hedge to protect against most downside risk. That's an options-based hedge. And in the future, we might use futures-based hedges on it. So this one has a targeted return of 8 to 10% annually. And what's nice about it, it has 30% less drawdown during crashes and corrections. And if the market goes down and stays down, your portfolio usually will come back in most situations. It will recover by 90 to 100%, usually within 3 months as the hedges mature. So if you have any interest in talking more about some of these, just let me know. Okay, quick couple more slides and then I'll jump in. This is just this is taken right off the website, qtrcapital.com. It shows the large cap performance. It's sitting at about 14.7% year to date. Last year it did about 30%. Most of these strategies have about 3 to 5 years of track record. Small and mid caps sitting at 17% year to date, did 16% last year. Here are some of the returns right now for each month, January, February, March for 2021. Sector rotation. This one is up 32% year to date. Last year it did 12%. And it's one of my favorites. Always gets a lot of nice ideas are dropped into this portfolio because this one's an all cap. It can handle smalls, mids, and large cap. So fewer restrictions. And so if I come across something and it just doesn't fit well enough into the large cap or well enough into the small cap, then I'll drop it into the sector rotation. Opportunity Alpha, this is the one I mentioned that's kind of on steroids. It's purely cyclical reopening trades, all the restaurants, anything and everything that was still down as of late last year. It's up 42%, and I'll probably shut this one down in about 6 to 9 months. And then Global Tactical Rotation ETF, this is purely ETFs, so it's on the risk. With regards to risk, it's on the lower end of risk, and it's more diversified around the globe, and that's what's nice about this one. So this was up 16%. This one has not been running that long, but it uses the same methodologies. So Don't let that scare you, because it's using a tried and true methodology, and that's what I'm going to talk about today. Let me check to see if there are any questions. Okay, looks like everyone can hear me. I see a few people that mentioned that they can hear me. All right, so here's our differentiation, and this, again, I'm going to teach you some of this. So if you want to do it yourself, this is my recommendation of how to buy stocks in this stock market, especially when it's expensive. So 4-level scanner and specific methodology is required. Now, not 100% required, but strongly recommended. And this is what we do. So 1, macro analysis, big picture. You're looking at technicals, breadth, fundamentals, sentiment, and you're trying to modulate bullish and bearish exposure levels. How much do you want bullish, long, and how much do you want short? And short's going to be, what we do is we buy puts on the SPY. They're called macro hedges. And when appropriate, we will open up macro hedges. We'll allocate up to 25% of the portfolio to the puts. And that takes a lot of experience. It's not an easy game of opening up bearish trades. What we do also is we'll write far out of the money call spreads to pay for those puts. Please don't try any of that unless you have a lot of experience in doing it. And we do have a lot of experience in writing credit spreads, because we've been doing iron condors and credit spreads on options for almost 20 years. So we can pay for those puts and open up those puts. It's kind of a tricky game, but it is good to put short exposure into portfolios once appropriate. Then you do a technical scan. We run scanners and we can find all the technical setups that we want in stocks. Then we do a fundamental screen, trying to find the strongest or the weakest companies. Right now, I'm purely talking about strong companies. We have not been shorting stocks at all for several years, and we don't plan to. If we're going to short anything, it's just going to be a macro short. We'll buy puts on the SPY, which is the S&P 500 index. That's an ETF, and that's just a macro hedge. So we're not shorting any stocks. Then we do a quant screen. Okay, that's more probabilistic, and I can talk about that. And then we use technicals to trigger entries and exits. All right, so this approach up here is sometimes called quantamental analysis. Quantamental analysis, that's the approach. We'll allocate 4 to 5% of the capital to each position. Okay, so back to the 4-level scanner and specific methodology. Here is the scanner we just talked about. Okay, macro, technical scan, you're looking for certain setups, technical setups, then do fundamentals, a quant screen, and then you finally use triggers, technical triggers to get you in and out of positions. So now a specific methodology is what I'm going to cover, and this is kind of the guts of how to protect yourself in this market. All equity strategies are actively managed. Most strategies aren't actively managed unless they say it's actively managed. Most strategies are lightly managed or passive, especially when you buy ETFs. Our portfolios are diversified across 24 positions on average, 23, 22, up to 25 positions. We might go into margin just a little bit, but not a lot. We'll push into margin because all portfolios are on margin. You can borrow up to 2 times. But we don't really like to be in margin. We might borrow up to like 0.2 of that, just a small amount. But it gives us a little bit of flexibility. So maybe up to 25 positions. We diversify across myriad industry sectors. Excuse me, and that's what you want to do in your portfolio. So you want to have a sufficient concentration to generate higher potential returns. I'll repeat, you want to have sufficient concentration to generate higher potential returns, but that takes work. It takes several hours a day for stock portfolios of looking for new positions, trying to figure out what you want to book and sell to get out and book your profit and rotate into something new. So it's an active strategy and allows you to have sufficient concentration. The minute you're over 30 stocks, you're starting to really over diversify, especially if you're in 40 or 50 stocks. A lot of these ETFs and funds, they have hundreds of stocks. So in that case, you're just buying the market. That's what you're doing. You're buying the market, and it's going to behave just like the broad stock market or the S&P 500 index. or the NASDAQ Composite Index. Those have hundreds, if not thousands of stocks in them. And what does that really get you? Well, it'll get you the market. Yes, the market has been going up. So everything's fine right now and everyone feels smart. But when the market stops going up and starts getting choppy and trades sideways for many months, then it's not great to have just broad exposure to the market, especially when it crashes or pulls back hard. All right, so you need to be somewhat experienced portfolio manager to set and follow well-defined entry and exit rules. This is very important. This is kind of a key piece of this presentation. Well-defined entry and exit rules. It dramatically increases the probability of entering winning positions and protecting investment gains and capital. Can you protect all your gains? No, you can't. You'll never time the top, you'll never time the bottom on anything. And you really want to be triggered by rules, and then if something's triggered, you're going to give some of those gains back, but at least you can book most of the gains, a big chunk of the gains. More importantly, protect capital, protect capital, protect capital. Right here, you got to protect your capital. So you need to have well-defined entry and exit rules to protect your capital. Even if you don't make a dime that year, that's okay if you protected your capital. If it was a disaster market, started pulling back hard, crashed, if you can protect your capital, that's your first step. If you didn't make a dime, all right, live with it. You lost 1% or made 1%, whatever. That's fine. You protected your capital and the stock market was a disaster that year. Can it be a disaster? Absolutely. Okay, so important to use a specific methodology. Why a specific investment methodology is important, especially when the market is expensive. This is the theme right now. When this market is expensive, how do you tiptoe around this market and keep on extracting out gains, but still be able to protect what gains you have or protect most of the gains, and how do you protect your capital? So the stock market is expensive right now. We're trading at about 23 times forward earnings. That's based on $180 of S&P 500 earnings. It should be closer to 19 and a half, maybe 20 times earnings. That's even pushing it. So about 12% lower. Now I've been telling people I read an advisory each Sunday evening, and it's free. So if you want to, go to upsideoptions.net and you can you can opt in for that advisory. It's pretty robust. It has about 50 charts in it. And I've been telling clients in that letter for about a year, I'm like, this market's probably going to get expensive and stay expensive all year as we reopen. So I wouldn't be surprised if we stay above 21 times earnings for a long time, for many more months as we reopen. And we have a lot of pent up demand, and we have stimulus checks landing in bank accounts, and people want to get out and spend money and eat at restaurants and travel and things like that. So I could see this market staying expensive for many more months. And when I say $180 of earnings, what I mean is if you take these 500 companies in the S&P 500, and like General Electric, it generates $1.50 of earnings, and Google generates $16 of earnings, and IBM generates $2.50 of earnings, quarterly earnings. You add all those up, you'll get $40 of earnings for a quarter. Okay, and then you multiply, and then you look at all 4 quarters in the future. So it's projected earnings. So you add up 4 quarters of earnings from these 500 companies in this index, and you'll end up with $180 worth of earnings. Who creates that number? Analysts do. So we have to trust the analysts. They have all these methodologies of predicting what earnings these companies are going to generate. And so that's where we're sitting at, about $180 worth of forward 4-quarter earnings. All right, when the market's in a confirmed long-term uptrend, even if it's overextended and very expensive, it is recommended to stay invested, but this is where experience comes in. So, however, it's critical to follow a specific investment methodology to protect investment gains and capital. So stay invested, keep extracting gains out of the market, even when it's expensive. But you have to be more experienced and know what you're doing. Best to follow an actively managed strategy that moves reasonably fast and is nimble. Recommended to invest in the diversified but concentrated strategies with 22 to 25 holdings, so it's concentrated. Best to avoid over-diversified funds like indexes, lightly managed funds, or passive funds that have hundreds of positions. These just mirror the broad market, and this market is currently expensive. Best to identify high quality, fast growing companies with good fundamentals and technicals. All right, so sorry, I'm just kind of reading this out, but this is the guts of all of this. I'm going to show this slide one or two more times, and actually, if you're interested in this, whether you do it yourself or if you want to hire us to do it, read it again and read it a third time. It's almost kind of like reading a textbook. So just make sure you understand every bullet in here. Best to identify high quality, fast growing companies with good fundamentals and technicals. All right, important to follow specific entry and exit rules to have have experience in knowing where to place the triggers. That's how you protect your gains. That's how you protect your capital. Most importantly, protect your capital. The more experienced you get, the more gains you can protect. So enter on fresh breakouts representing a low risk entry point. Low risk entry point, that is key here. Fresh breakouts equals a low or a lower risk entry point. Don't enter stocks once they've made a run or become overextended. This represents a high risk entry point. Follow well-defined exit rules to stop a position out or to book gains when triggered. Okay, so all of the above is important to make consistent positive gains in the long run in the stock market, and most importantly, protect your capital and protect the gains that you have. Try to protect a chunk of those gains, and you should be able to protect up to 70% of your gains before they get triggered out. And all of this is, especially when this market is expensive. That is the theme. This market is expensive. All right, let's jump into some charts. Let's see, I'm just going to see if any questions have come up. Okay, I'm going to come back to these. We can do this a little later. All right, let's look at the charts. Macro level, S&P 500, the market's been on fire. It's just been nonstop up, up, up. It's just, Mr. Market's going to do what it's going to do, whether you agree with it or not. So you can't let it drive you crazy. You have to react accordingly. The boss is the market. The market is the boss. We will follow what the boss does, and then we have to react accordingly. So don't get emotional about it. Be mechanical about it. And this is good when you have multiple strategies. You want to be diversified across myriad strategies. So the strategies, you might have a trading strategy that struggles when the market's moving too much. So that's, that one takes more work and it's not making as much, not making anything. And then other strategies could be booking gains. Those are the long strategies. So you kind of do want to have, myriad investment strategies across your portfolio. Some will be performing, some will not. And everything ebbs and flows. All strategies ebb and flow. So if you're long the market right now, it's flowing. Everything's going up, you're making money. You can actually extract more out of the market if you select the right stocks and follow the right, more specific methodologies. But even if you're doing nothing and you just buy the market, just passive, and you just buy some of the indexes or some of the ETFs, broad indexes, you're making money. All right, so everything is up right now. This is just a daily chart of the S&P 500 index. I show a 13-day moving average. That's red. That's an EMA, exponential moving average. 50-day EMA. I show 150-day SMA. I show a 200-day SMA. If you don't read charts much and you want to kind of get started, start with this. Start with a 13 EMA, 50 EMA, 150 SMA, 200 SMA, and then spend some time. Good place to go is stockcharts.com. They got a pretty good learning area for technical analysis, and just read. It takes a couple hours. Learn about chart reading. Also, you care about support and resistance. These are all support and resistance lines. Always draw your horizontal lines. And right now, 3580 was a major line right there, for example. 3330 was a major line. 3800 is a major line. So make sure you care about support and resistance. So confirmed, long-term confirmed uptrend. Now, here's the weekly chart, and always look at the weekly chart and the daily chart, usually together. And the weekly chart here shows a 17 EMA and a 43 EMA. So if you want to get a gold nugget out of this presentation, use these averages right here. 1743 on the weekly chart. And if the 17 is above the 43, you are now most likely in a long-term confirmed uptrend and you can go long. When it gets choppy, it's tougher. You need more experience of how to navigate it. But if you want to, like, wondering when to buy gold, bring up the chart of GLD or gold, GOLD, or one of the miners, GDX, and open up and watch a weekly chart. 1743, it's a little slower moving, but it gives you nice confirmation, pretty nice confirmation. This works well. Actually, I stole this from some analysts at the S&P 500, analyst group. They worked over at Standard & Poor's, and I think they came up with this like 25 years ago, and I came across it, and I've been back testing and using it and love it. All right, so when the 17 is above the 43, start going long and stay long, but be careful. But you have to watch other things. You can't just watch one thing, but you have to watch many things. But this is a nice one, especially when it comes to slower moving things like interest rates. Like trading the TNX, which is 10-year Treasury, or trading gold, GLD. Sometimes when that thing goes in a bullish run, it will run for months, quarters, or years. Same thing if it starts rolling over and all of a sudden the 17 is below the 43 on GLD, it'll stay bearish for many years. So don't lock up your money in gold, for example, unless you just want it in the drawer for whatever other reason. But don't lock up your money because it could be locked up for years and go nowhere. 1743 can help you get through that. All right, market breadth. This is cumulative advanced decline line. It's a very important market breadth indicator to watch. If you can only watch one thing, watch this. So this is cumulative advanced decline line. Actually, I get this off of stockcharts.com. And every day you have the S&P 500 has 500 stocks. So every day there's going to be a number of stocks that advanced that day, and then the balance went lower that day. They declined, advanced decline. So you take the advance minus the decline and you get a number, an integer. And that integer is, whatever number you get, you add it, and you just cumulatively add that number over and over and over, day after day after day after day, and you get this chart. Okay, and then I threw some moving averages on it. I have a 1740 on it. And if you see that thing trending up, the stock market is going higher. Pretty darn high probability. So like if you want to be going bearish on something and you see some of the major indexes still have positive advanced decline lines, not recommended to be going short. All right, now this is interesting. The NASDAQ, I'm seeing divergence, and I'm still trying to process this, but NASDAQ composite that has, I think, 1,900 stocks in it, a lot of them tend to be tech, which makes sense. But look at this. So 17's crossed the 43 on this one. So I'm seeing some weakness in the NASDAQ composite. This is usually, it could be a transition point, but it could take many, many weeks, if not months. So we have to be careful with, is this market getting toppy and choppy? Well, not yet. Look at the S&P 500. This thing is just taking out higher highs. It's incredibly strong. Okay, let's look at sentiment. You always want to look at Microsoft, Apple, Google, Amazon every single day. Just take a look at it, see if this market, what's the sentiment? Are people still bullish? Are people still happy and motivated to buy stocks even when they look expensive? Not to say that Microsoft's expensive and not to say that Apple's expensive. They're not actually, but the charts look overextended, but are people still willing to get in? By the way, these were yesterday. Everything was down anywhere from 3 to 5%. I think Tesla was down 5% or something today, so it's just a red bar here. And these are weekly charts. I'm showing the 1743. 17's way above the 43. You can just see Tesla just launched. It's like a 9-bagger this year if you were in from down here. So What I care about is, what are the high flyers doing? Shopify, Tesla's, Teladocs, Documentum's, Coupa Software. I mean, just name them. There's literally 200 companies that just went nuts and they went straight up. So that's not sustainable. Most of these are going to come back down to earth, but it still tells me, what type of, is there money still flowing in this market? So people are still willing to get into Tesla. This is current earnings. PE is like 400, but if you're looking at forward PE, it's probably trading at 200 times earnings. That's still very expensive. Teladoc is rolling over a little bit. That tells me something. Square, yeah, straight up. DocuSign is still up. I don't see a lot of fear at all right now in this market. Shopify is still straight up here. The big guys, Apple, they're not bad. They're only trading at like 35 times earnings. So they're not expensive for huge companies that are growing so fast. It's very impressive. So people are still willing to get into Apple, Microsoft, Google. Just tells me that, Amazon, I think it was down maybe 1.5% today. Money is still flowing into stocks. All right, earnings. Let me see if there's anything I need to answer. No. For questions, okay, earnings. We care about earnings. This comes from FactSet. You can just go into, oh, here it is up here, FactSet. They got a free report each week. Just go into Google and type in earnings insight FactSet, and you can, about a 20-page document comes up. So I try to read that each week. Not all of it, but I try to scan through it. This black line right here represents forward 4-quarter earnings. This is what we care about. This is what ultimately drives the stock market and drives valuations. Over time, of course, the market will ebb and flow around that. It'll get overbought, underbought, oversold around that. But over the long run, corporate earnings is what drives stocks. And we could see corporate earnings drop down to about $140 worth of earnings, forward 4-quarter earnings for the S&P 500. It's up to about $180 worth of earnings. So that's impressive. It is very impressive that companies have figured out how to keep on making earnings, generating positive earnings growth during COVID. And then the blue is the S&P 500 index. So that's the price of the S&P 500 index, the SPX, and that it comes off of this y-axis over here. So we're up in the 4100s for the S&P. All right, so earnings were hit hard from COVID. That black line pulled back hard. S&P 500 companies are now projected to generate $180 of forward 4-quarter earnings, which is impressive. I'm impressed. Market's trading about 23 times earnings, maybe 22.8 as of today. Market is classified as expensive. Simple as that. This will not last forever, but we have so much disruption and dislocations in the market from COVID that it's just hard to know where we should be. And right now, traders are willing to keep the market expensive. And could it even get above 23 times earnings as this economy reopens? Well, it could, just due to just massive dislocations we've had in the last year. All right, economic data. I only have 2 slides here. Usually I'll show 3 or 4, but there was just so much dislocation in the economy that I don't show too much. Non-defense capital goods orders. This is basically durables minus aircraft and transportation and some of the more volatile stuff. This represents business spending. Are businesses buying computers? Are they buying equipment? And they are. They're actually kind of getting back to work and they're buying stuff. Retail sales, that's what consumers in the United States are spending on stuff, whether with cash or credit cards. That represents about 70% of the US economy. And it's been bouncing all over the place, but it's not bad. I mean, retail sales had a weak month recently, but this economy is reopening and we have pandemic checks landing in bank accounts again. So it's gonna pop retail sales easily for the next 3 or 4 months. This is the yield curve. This is the 10-year minus the 2-year. So this basically drives banks. Whenever you see the difference between the interest rate on the 10-year treasury minus the 2-year treasury, it will drive valuations of the banks, the regional banks. And so whenever you start seeing this, you want to get into the banks. And so most of our portfolios had a lot of banks in them. I'm starting to actually cut some of the banks. I want to book those profits. And then unemployment claims, how many people are filing unemployment claims each week? And it's been dropping. We're still getting about 800,000 claims. We're not through this yet, but things are getting better. All right, and payroll. Payroll's okay. We still got about 10% of the population, or 10 million jobs. I'm sorry, 10 million jobs are still missing in action, but the unemployment rate's getting better. We're around 6%. ISM index is manufacturing in the US. This is not a huge part of the economy these days in the United States. I think it's like 10 or 15% of the US economy, but still a chunk of it, and it's growing. So people are manufacturing and selling goods. Overall, things are getting better. Okay, macro analysis, market sectors. What we care about, I got several tools looking at that, market sectors. This one's especially important when I'm doing the global sector rotation ETF. I'm trying to rotate into the strongest sectors, and I'm trying to book profits of anything that's dropping off. And money is constantly rotating from sector to sector and around the world. So the first thing I care about when I look at sectors, here's the rank, 1 through 25, 26 through 51. Here's the rank. The top is industrials, XLI, and then home builders. Here's the S&P 500 index. That's impressive. The S&P 500 index is right at the top. It's ranked 4. Some of the ones I checked are good sectors to be leading because the economy is reopening. So we have industrials. This is good. This is bullish for the economy in general, and the industrials will start climbing. Home builders, that's interesting. It makes sense. I guess home building really never got weak, even through COVID. Everyone wanted to just buy homes and move out of the cities, and so that was an interesting one, but they're still strong again, and interest rates are low. Financials are looking good. That's usually a good leading indicator for the economy, broad economy, and the stock market. Materials, same thing. That's a leading indicator for the stock market and the economy. Construction, this one's going to be looking good, especially with Biden talking about the infrastructure bill. Steel, forward-looking. Transportation. Actually, I'm surprised that transportation's 29 because it's still strong. I figured it would be somewhere here. All right, so this is just looking at sectors. Overall, this is a positive. It looks decent. I like that. All right, should we be opening hedge trades? Open macro hedge trades when appropriate. They'll be triggered. When macro breadth indicators weaken and when certain support levels are broken, we'll buy slightly out of the money puts on the SPY. Right now, we'll allocate up to 25% of the portfolio to bearish trades. We haven't been bearish in a year. I mean, when COVID hit, it hit so fast that it's hard to open any hedge trades that fast. We were literally down 4% a day. One day we were down 10%, I thought. In 3 weeks, we were down 35 to 45%. If you don't have hedges already open, forget about it. You're just going to have to live through the crash and get through it. And then since we found a bottom by August of last year, more like June, July of last year, you don't really want to be buying hedges when the economy is, when things, the stock market is starting to recover. Okay, back to the 4-level scanner, macro analysis, technical, breadth, fundamental, sentiment. We're trying to modulate bullish and bearish. We just covered most of the stuff that we look at there. All right, next, let's go into technical scans. All right, we need to look at a bunch of charts. So in general, what we do, not everyone likes to do this, but this is what we do. And it tends to be, I've seen enough data in the past that most of the funds that follow this methodology tend to do pretty well. We like breakouts. So we do breakouts, and here's an example of Home Depot. This is the daily chart up here. Here's the weekly chart down here. Here's the 13 moving average, 13 EMA, 50 EMA, got 150 to 200 SMAs, simple moving averages on here. And we're looking for consolidation. So this is nice. Here's the weekly chart. Here's 2017, 18, 19, 20. Weekly chart means each candlestick represents 1 week of trade. Got the 17, I got the 43 on it. Here's COVID. COVID crash, took Home Depot down to 158 bucks. A lot of dislocation. Home Depot actually broke out, I think it was more like July, got over 250, went up and then started consolidating sideways for a long time, many months, and now it's breaking out again. So that consolidation creates a nice support level right there. That's a resistance support level. It's resistance until it gets over it. Now it's classified as support. I will call that a low risk entry point because you know where your stop is set. If that thing breaks below 291, you're out. You're out. Or here's your 200-day line. If it gets down in here again, you better be getting out soon. If that thing breaks below the 200-day line, it's coming down to 247. So we're pretty strict on these rules here, and we'll be out pretty fast. So we'll call that a low risk entry point, and that's a breakout. Okay, so what I'm talking about now is this slide here, which I covered at the beginning of the presentation. And it said, basically, if the market's expensive, it's okay. You know, stay invested, stay in the market. Stay invested, keep extracting gains out of the market even when it's expensive, but follow very specific rules, or at least you should consider them. And this is what I'm going to be talking about now, this red part. Important to follow specific entry and exit rules to have a lot of experience in knowing where to place the triggers. So enter on fresh breakouts. That represents a low risk entry point. Don't enter stocks once they've made a run and become overextended. This represents a high risk entry point. Follow well-defined exit rules to stop out positions or to book gains when triggered. So follow well-defined exit rules, follow well-defined entry rules. So for Home Depot, there's your entry right here. Don't do it on day one, but day 3 could work, day 4 could work, day 5 could work. Make sure it stays over breakout. I would not buy it on day 1 or day 2. All right, so I'm just going to go through some of these, like Home Depot, that went into the large cap when that thing broke out. MMC, actually, I just put this one in the large cap, actually today, I think. Yeah, it's today. Yeah, that went in today. So there's a nice breakout, nice long consolidation period. Went up, pulled back, been consolidating. The only thing about being careful with insurance brokers, I mean, I like insurance brokers, but they tend to be slower moving. Sometimes when they get stodgy and start slowing down, they'll slow down for months and months. So now you got your money locked up. So just kind of keep that in mind with insurance brokers. So that was Marsh McLellan. Here's Moody's. This one actually went into the large cap recently. These are all bigger cap companies. Look at that long consolidation period. That's like 6 months worth right there. That's beautiful. Now, we don't want to follow just technicals. I'm going to talk about the qualitative part also, the fundamental part. You want to make sure that these are good companies. All right, so Moody's, here's PII, Polaris. This one's a little different. It just broke out up into here. Okay, so this one's going into our sector rotation portfolio. It's like 9 billion market cap, strong earnings growth. And it got over this level. You just want to make sure it stays over 137. You know, could this thing fail and come back below 137? Yes, it could, and be careful. Thermal Scientific, what's interesting about TMO is look how it came down to the 200-day line and just started consolidating and sitting on the 200-day line. That's very nice. You can get in around here. This is going back up to here. Most of our strategies actually will sell when it hits 520. And then we'll re-enter once it gets over 520 because you just don't know how long it's going to take to get back over 520 or to break over 520. That's a tough line right there. That's a big resistance line. So you can actually get in right here and you can make your 10%, 8%, 5% in and out in literally a couple of weeks if you want. Just be careful because you can come up here and start failing, and if the market starts misbehaving, this thing is coming right back down to its 200-day line pretty fast. And then it could break back below 450 and now it's going lower. So make sure you have your style and your exit rules in place. PKI, Perkin-Elmer, same thing. Look at this nice consolidation right on top of the 200-day line. That's the SMA. It's just breaking out now. It's getting back over the 50. Once it's back over the 50 and once that 13 crosses up through the 50, that could be an entry rule for you. So if you don't have any exit or entry rules and you don't have experience with this, use the 1350 to start with. 13 EMA, 50 EMA. That's a good one. The 13 is back above the 50, higher probabilities it's going higher, but everything's probabilities. Just make sure you protect yourself. If that thing starts breaking back below the 200 and it stays and starts taking new lows down here, lower lows, get out. And do not buy on the way down. It's not recommended to be, dollar cost averaging. It's just not recommended to do that. Unless you know everything about that company, you're an expert on the fundamentals of that company, you know exactly, you have a lot of insight into the fundamentals, then maybe you could dollar cost average. Just make sure that you're very well informed on the fundamentals of that company. Medtronic, just starting to break out. This is probably going to go into our big cap sometime in the next couple of days. And a lot of pacemakers, a bunch of equipment going into the hospitals, and this was hit by COVID because a lot of this type of work was postponed. People stopped going to the hospital even though they had heart issues, or like, I can live without it, or the doctor's like, hey, wait until after COVID. So I have a feeling Medtronic is probably going to be a nice stock for the next year. ChemMed, here's an example of a failure. So here's one kind of breaking out, failed. You have to be careful. You have to set your own rules. How many days do you want to wait until you get in? Here it took off again. 1, 2, 3, 4. Got over that. That's pretty nice. That's an entry rule. You can get in there, but look at this. It failed. So you got to be nimble, and you have to make sure there's kind of like ice water pumping through your veins. You need to eliminate emotion. If that thing starts triggering an exit, you exit. Do not use emotion. Now this one's not looking too good. We'll see. I mean, this is a good company in general. It's growing good earnings. ChemMed Medical Care, I had it. We got stopped out, probably took a 7% loss. That's pretty typical, 5, 6, 7% loss on something like this. Probably had a 5% gainer and it went through a 7% loss. This thing needs to get back over its 50-day line, and that 13 needs to get back over its 50. And it really needs to get back over its 200-day line before you can trust this stock. Okay, I will repeat that. This 13 needs to get back over the 50, and probably even more importantly, this stock needs to get over that 200-day line before you can trust this stock again. So it's a no touch. Cigna, well, the big health, this one went into the large cap, nice breakout. Look at this, tons of consolidation. Yikes, that was like 3 or 4 years of consolidation. First time it broke out in a long, long time. So that's nice. That's very nice. Brown & Brown, another insurer, starting to look at all the consolidation here. You have to remember, this is a weekly chart, so that's like 5 months worth of consolidation. More than that. Look at that, beautiful. It's an insurer, it's a very good insurer. It moves more slowly. You need to be a little more patient with these insurance brokers. Okay, let me show you 5 charts of that go into this strategy. Opportunity 1, so this one is buying the depressed restaurant, retail, department stores, clothing manufacturers, hotels, casinos, anything that was shut down from COVID. So these charts look different. And we have a scanner, we have scanners that run these and spit these out for us, so we don't have to really try to find them that often manually, because they're just automatically generated for us. But you can see Red Robin. Now I don't like how this thing, look at the 17, this is a weekly chart. See the 1743? 17's been below the 43 since early 2018. So I don't like that. I would prefer one that's more like kind of coming across and then just got slammed from COVID, and then you know that it's going to rebound faster. So this one kind of tells me that there's maybe some structural issues with this company, but regardless, COVID killed it. It was all the way down to like 10 bucks. 17 went back over the 43, and then it started getting over this resistance level here, 35 bucks, almost 36 right here. Here's the daily up here, 36 bucks. It's just getting over it. This type of chart is what all of the stocks look like that have gone into opportunity 1. So there's one right here. Here's Movado, luxury goods. Same thing, kind of interesting. Mid 2018, 17 went below the 43 on the weekly. Tells you that this stock is in a long-term confirmed downtrend. don't be trying to go long it. Just make sure that you know what you're doing and you have a lot of experience. If anything, you're going to have traders that short it. They're going to be buying puts, or they're going to be shorting that stock all the way down to this support level here, and then it even broke below it, even before COVID. It's kind of crazy. But once COVID hit, we came down here. It rebounded, and now you can trade this stock. You can make money from here up to here, and then you can make money from here up to here. So these stocks all look the same. Here's a gap, same thing. You can make money from here up to there, make money from here to there, there to there. It's called cycling. We'll kind of cycle these stocks. You get in, make your 20, 30, 40%, get out. You know, goes up to hits resistance, get back in, make another 10%, get out. And then, because sometimes it'll go sideways for a long time. And then once it breaks above, you can now make another 15, 20, 30%. So called cycling the stock. Our goal is to try to make a 50 to 100% gain on these as the economy's reopening. Here's GIII, it's an apparel group. They manufacture clothing, same thing. Kind of interesting. Most of these kind of look similar, where they were kind of in these bearish downtrends. Now they're recovering. And then the next trigger is going to be anything over 33.70 up to here. So these take several hours, you know, at least an hour a day, sometimes 2 hours a day, you know, as the portfolio manager is looking over these. And step one, make sure you look at them every day, every single day. You got to look at your positions. Step two, figure out what you want to rotate out of and rotate into. And that takes time. Okay, so that was what I just showed you, was technical scanning, kind of finding stocks, and then using triggers to get you in and out. All right, next, fundamental. I think we'll be done here shortly. Just a couple more slides. Here's a fundamental screen. So we use MarketSmith. I like the tool. It's a little pricey at 150 bucks a month, but it gives you all the data that you need. So we care about fundamentals. You want to make sure that the company that you're looking at just happens to be a Stanley Black & Decker. Here's earnings growth over here, how much earnings are going to be growing, how expensive the stock is, what its PE ratio is. Here's some of its competitors, its relative strength. You care about the relative strength of the stock. And there's a few other screens that you go to, and it shows you from quarter to quarter to quarter if it's growing earnings. It's kind of like this data down here, but it's in a different screen. It shows earnings per share and if they beat earnings or not. So very important. That is the fundamental piece. So all the stocks, you have to look at the stock and make sure that you are happy with the fundamentals. You, in general, want the top 25 percentile. So top 30, top 25, top 20 percentile in earnings growth. That's what we primarily focus on. Okay, quant screen, quantitative screen. So this is more probabilistic in nature. And so this uses econometric statistics, mathematics. It provides predictions, such as the probability that a stock will break up or down through a particular level, probability that a stock will move a particular magnitude up or down once it breaks through a level. So this requires several years of education in statistics, econometrics, along with a couple of years of experience in developing and optimizing these linear regression models. And this has always been an interest of mine, and this is what I teach at the university level. And this is what the output looks like. So usually we'll run our favorite 3,500 stocks through it, and then you get all these probability numbers, and it's just another way of screening. It gives me a final screen. So I might get 6 printouts a year, six printouts a year, and that data will be good for a couple of months. So it just gives me additional information on screening. Okay, so this is a summary of the methodology. So what we've talked about is kind of a four-level quantum mental analysis. So it's blending technical fundamentals and factor-based quant. The key here is actively management. So active management is required, especially when this market is expensive. Just buying indexes and holding them, anything passive or very lightly managed, anything with hundreds of positions, I don't like it. I don't hold them in our stuff at all. And you know, you can buy them, but you're fully exposed. Is this market still going higher? Yes, it probably is. It probably is for many more months. Now, how much higher now? How much more can you squeeze, squeeze out of the S&P 500? Could you get another 5%, another 7%? Well, maybe, but there's also a lot of downside risk too, because this market's expensive. So it's better to actively manage, get into new positions at low risk entry points, which I've discussed. So best to buy the fresh breakouts. That's the well-defined entry rules, fresh breakouts. Do not chase stocks that have already run. You missed it, move on. Or you were in one, you got out with your 30, 40, 50% gain, take it and be happy. Open hedges when appropriate. We also have a unique methodology in doing this. As I mentioned, when it's appropriate to buy hedges, then we'll write some far out of the money call spreads, and that's part of the overall allocation. We'll allocate up to 25% of the portfolio, and some of that's used for writing call spreads to pay for those hedges. So our goal is to make the hedges free, and then we can hold them longer term. Because we can make them free, then we don't stress out as much about the hedge, because the hedge can lose you money if you're wrong. It's like buying insurance. You buy insurance and it's a sunk cost. And so I try to make that sunk cost as cheap as possible. All right, follow well-defined exit rules. So let the winners run as long as possible. This takes experience, but exit fast enough to lock in whatever gains you have and to protect your capital. So for example, here's an example where it worked beautifully. In October 2018, all of our portfolios were at 70%, 75% allocated. And within about 6, 7, maybe 8 days, we went from 75% allocated to 15% allocated. And then we had a big correction. It was a really nasty correction at the end of the year. And so our portfolios all ended up in the plus 18 to plus 25% range, and all the benchmarks were down for the year, -8 to -12. So that worked out nicely. But it takes experience, because you just don't want to be getting whipsawed and chopping all over the place. You do want to hold things if you can. Okay, so let's go to the questions. How do the major index charts and sector ETFs look? What are they telling us? Well, this market's still in a long-term confirmed uptrend. What are the breadth indicators telling us? I'm seeing some chop here. So the SPX for the large caps, they're still strong. But for the NASDAQ composite, it's weakening. But for some of the other indexes, they're still strong, like the NYSE composite, the QQQs, that's the NASDAQ 100. That one's still strong. How do corporate earnings look, and what are the analysts projecting? Earnings look pretty good. We're at 180 bucks worth of earnings. I think we're going to end up at, before we know it, in the next 2, 3, 4 months, we're going to be at 185 bucks worth of earnings. What's the price action of all the big mega caps doing, and how about all the high flyers? Well, 2 weeks ago, I would have told you the high flyers, the dam is breaking. They're slowly starting to roll over. Now, some of these already got back over their 50-day moving average, which is pretty impressive. I just don't think that this is sustainable. I think that it's just going to be a slow motion dam breaking on these high flyers, and then I think they're going lower, but not yet. Looks like they're back over their 50-day lines, and people might be pushing them back up to their highs again. But everything looks pretty bullish still. How expensive this market? Very expensive, 23 times earnings. Could it go higher? Probably. Will it correct? Yeah, we can have a 5% pullback at any time. Could be a 7% pullback at any time, but is it going to bounce? Probably. Probably be right back up to its highs within 3 or 4 weeks. Is it sustainable? Well, over the long run, no. Once this economy opens, we're going to probably come back down to about 19.5 to 20 times earnings. So things need to come lower. But you have to remember, earnings are growing. So we have these cross currents. So earnings are kind of helping to keep maybe this level somewhat justified, but it's still expensive. Why are actively managed strategies and well-defined entry and exit rules required? Well, I think I've already discussed all of that. If you want to protect your capital and protect your gains, you gotta follow have exit rules always in place before you even open something. Or when you open it that day, what is your exit rule? Always have exit rules set and follow them. Do not get emotional about it. Be mechanical in nature. Should I add short exposure hedges to my portfolio right now? Probably not. Not for many more months. And these are not made for quick pullbacks. It's not made for a 5% correction. We can have that at any time, and it's going to be so fast that sure, I can generate something with the hedges, but that takes a lot of work. It's more complex, and you can't navigate that fast with the hedges. Should I buy bond funds? No, unless they're really, really short term. Make sure the maturities are all 3 months or less. Those are called money market funds. You can make your 2%. That's safe money. Will not be impacted by rising interest rates. But right now, interest rates are rising. They will continue to rise, and that will impact bond funds. So anything that has longer maturities, like 6 months or longer, they will not make, most likely they will not make money this year, and they'll probably lose money. So if you have money in bond funds, make sure it's short maturities, meaning 3-month-ish maturities. It's usually called money market funds. And ETFs, there's ETFs that you can do that in. So you can make your 2%, that's about it. Okay, is the risk reward trade-off of holding the major indices or lightly managed funds or passive funds? Is it optimum, is the risk reward trade-off of holding these optimum? Not really, not really. I would be stock picking, I would be ETF picking, I would be using active rules. That takes time. Be nimble, be very nimble. This market is expensive. Sure, you can buy the SPY, put all your money in the SPY, and maybe you can make another 5%, but your downside could be really ugly. It could get pretty volatile. So what's better right now? The value, growth. Didn't really talk much about this, but value is doing really well. So ETFs with the word value in it are doing well. So look for those, especially mid-cap value. Small caps, it's still doing well. It's just kind of, look for small cap values also. That looks they look good. Small caps, mid caps, just about everything is doing okay. Europe's looking good. Parts of Asia, I'll be adding Vietnam shortly, probably to the global sector rotation ETF. That one's breaking out. Most of these thematic ETFs, they're all really expensive. Solar, other clean energies, cars, anything, these thematic ETFs, these really sexy, cool ETFs, man, they just went parabolic. So be careful with these. You just don't want to touch these, the robot ones, robotics. I had those and I already booked my profits. Okay, didn't really show too many ETF sectors, but financials look good, industrials look good, materials look good, for example. And stocks to rotate into, anything that's kind of following those ETFs. All the industrials are looking good. All the financials, be a little more careful. They got really overextended. I think they're going to take a rest. But overall, the banks are still pretty strong. Okay, back to this last slide. Just reread this if you like what I'm talking about here. Come back to this presentation. This is being recorded, and it will be on the website as of tomorrow, the upsideoptions.net website. I might even have it on the QTR Capital website. And look at this text. So read it twice, read it 3 times, and then see if your personality can kind of resonate with this type of strategy. Okay, these are actively managed strategies. If any of these look interesting to you, you can reach out to us. All of these are auto-traded through Upside Options, and then these are all separately managed accounts through QTR Capital. So it's pretty much the same methodology. So you have access to it through the newsletter, and those are all, you can start as little as $10,000 for those accounts. They all start at 10K and move up in 10K increments. That's for Upside Options. And then once you hit about 100K, then we'll ask you to move over to QTR Capital. And those are separately managed accounts. And then we charge a percent of assets, kind of in the range of 1% up to 1.3% of assets depending on the strategy. Okay, so that is that. So I am out of time here. All right, I've answered a few questions for Avi. He was asking about what brokerage accounts. So for our custody accounts for QTR Capital, we're using Tradier for those custody accounts. So TD Ameritrade is, kind of a favorite go-to, but they were just bought by Schwab, and that was kind of stayed away from that, them going through their merger. So I'm using Tradier for QTR Capital for those types of accounts. And then we trade percent of assets, or that's what we charge, percent of assets. So Avi, I can get with you after, offline, and we can talk in more detail. Okay, any other questions? I don't see too many technical questions. And this one, I did not have time to go into the options trading strategy. That one gets a little more technical. This one was purely focused on the equity strategies, the ETF strategies, the entry rules, the exit rules, why it's important to be actively managed. And so that's purely what this presentation was focused on. Okay, I think I'm going to cut it off here at 3:08. Thank you very much for joining the presentation, and you'll see an email down here, support@qtrcapital.com or brad@qtrcapital.com. There's our website. Also, all the strategies have track records shown on both upsideoptions.net and qtrcapital.com. So just let me know if you have any more questions, and I'll talk to you later. All right, have a good day. Thank you.